You're welcome to Ristal Institute. My name is Sarah, and I'll be taking you through balance sheet calculations. So in our previous lesson, we talked about what is balance sheet, and we looked at the format of balance sheet. So today, let's dive in and look at an example of how to calculate this balance sheet. We see that balance sheet it is very essential as an organization, as a business, or as a finance manager. You should be able to come up, because it shows that it shows how your business is doing. So it is very good for you to know how to calculate this balance sheet. So let's look at our example. They've given us an illustration, is information. So we are going to use this information to come up with our balance sheet. So they've given us cash, bank, and stock, everything here, but we are going to identify. Remember our equations, we say that balance sheet equals to assets equals to liabilities plus shareholder. So your assets should be equal to your liability when you add your shareholders equity. So we see that here in this illustration they've not given us shareholders equity. However, they've given us capital. And also we have some drawings. So what does it mean? It means that we are going to use a formula whereby we can be able to come up with our shareholders equity. We shall calculate our shareholders equity. So what is our shareholders equity? It is that very amount that belongs to the owner of the business, or that belongs to the business. So we say that would have given us also additional information. So this additional information, which when we are looking at this is the same example that we are using. It's the same example that we used in our income statement. So I advise all of you, before watching this income statement, this balance sheet calculations, you should first understand the income statement. You should first watch that video of the income statement, so you come to understand, because there are certain things that I'm not going to repeat. We shall just put the answers. So this additional information, we shall not generate journal entries, since in our when we were looking at income statement, we generated our journal entries. So we talked about the note and the certain key things that we talked about. So before watching this video, make sure that you watch the other video and understand it. So it will make you to be able to follow up. So we are saying that when you're coming up, when you're looking at balance sheet, or when you're coming up with the balance sheet, because this one, when you have to present it, so you write the name of the company. So we say Blessed Enterprise Limited. The statement of financial position, the same as the balance sheet for the year ended December 2021. So we have our SSP sign, and then SSP. So what do we do? We say that getting balance sheet, we say that we have our total assets minus liabilities plus shareholders equity. So we are going to first identify. Remember, we have two types of assets. We have what we call fixed assets, and we have what you call current assets. So when you're calculating for this, when you're coming up with your balance sheet, we start with our fixed assets. So we identify what are our fixed assets. Remember, our fixed assets, they depreciate. Fixed assets depreciate apart from land. So fixed assets depreciate, and in our illustration, they have given us that say that we have equipment and vehicle. They're saying us that the vehicle has depreciated by 20% of the total cost. So what does it mean? We are going to come up with our net present value. So that net present value is the one that we are going to use in our balance sheet. You're getting the point? Yeah. So we say fixed assets. So fixed assets. So our fixed assets. So we have the cost. We get the cost. So we get what we call cumulative depreciation. Cumulative depreciation. And then we have what we call net present value, NPV. So this is our formula that we are going to come up to be able to come up with our total fixed assets. So they said we have what they have given us vehicle. They have given us vehicle. And they said the cost of the vehicle is 7 million. In our illustration, we are following the illustration. It's 7 million. I cannot go back to show you because of, but I hope you can be following. You get that aside and then you'll be following as you're looking at your illustration. So the illustration here, in our illustration, they've given us the cost as 7 million. So how do you come up with the accumulative depreciation? It means that we are going to get the 20%. Remember, in our additional information, they've said 20%. The depreciation was 20%. So we get the 20% of 7 million, which we get 1,400,000 SSP. So how do you come up with the net present value? You subtract. You subtract. So when you subtract, you say 7 million minus 1,400,000, which we shall get 5,600,000. So this is the figure that we shall take in our balance sheet. It's the one that we shall consider. So the equipment. For the equipment, they have given us 5 million. And then for accumulative depreciation, they are telling us that 10% of the cost to get the accumulative depreciation. So when you get the 10%, you get 500,000. So when you subtract 5 million minus 500, you get 4,500,000. So we get the total fixed asset. So you get the total cost, which we shall get. You add 7 million plus 5 million, which you get 12 million. You get 12. And then when you add the accumulative depreciation, 1,400,000 plus this, you get 1,900,000. And then when you add the net present value, you get 10,100,000. So this is the amount that we shall take. This is the amount that we shall take as our total fixed asset. So let's go ahead. Having calculated, that works only for fixed asset. So after getting for fixed asset, what are we going to do? We are going to add our current assets. So we are going to add our current assets. So we say current assets. So we find out current assets. Current assets. current assets. So our current assets, we have the stock. So when the stock that we count here, we take the stock, the closing stock. So when you're taking the stock, we always take closing stock. So remember, when you're calculating balance sheet, you have to follow the order. So it means that you start from the stock up to cash should be the last. So the stock, we have debtors, then we have rent and bank, and you follow that order. So we start with stock. Our stock, we shall take our clothing stock, the one that is 31st December 2021. It's the one that we shall take. And then the amount, they have given us the amount as 1,500,000. So we have debtors as our current asset. We have debtors. So remember, debtors, they have given us debtors, and then we also have what we call provision for bad debts. Provision for bad debts. So we have our debtors that have given us 3 million as our debtors. So there is bad debts, there is provision for bad debts. So we shall less the provision for bad debts. Said bad debts, these are the people that you're demanding that they have failed to pay their debt. So the bad debts, the amount, they were 90. The amount was 90,000. Remember, I said you should be able to watch our previous lesson. So we have additional information, which when we calculated the provision for bad debts, we got as the provision for bad debts is 90,000 SSP. So this is what we shall less, and then to get the total debtors, we get 2 million. We get 2,910,000. 910,000 as our debtors. So then we have our prepaid rent. We said all prepaids are counted as current assets. Every prepaid is current. It's all prepaids are counted as current asset. So we put prepaid rent, which was 100, which was 100. Prepaid rent is 100,000. And then we have rent, that is prepaid rent, and then we have bank, which is bank was 2 million. Bank was 2 million. Bank was 2,500,000. Then we have cash as our last current asset. Cash, which is cash was 800. So when you add the total current asset, we get 81,000. We get 7,810,000. So having gotten the current asset, we need to get working capital. Remember, they have not given us shareholders equity, the money. So we are going to use the formula whereby we are going to come up with our working capital. to get the working capital, what does it mean? We shall get current liabilities. So we shall get current assets minus current liabilities to come up with our working capital. So when we come up with our working capital, that's when we shall be able to come up to get our net asset. So we shall say we are lessing current, we less current liabilities. So we identify what are those current liabilities that were given. So the current liabilities, we have creditors, the amount they have given us, creditors, as the amount was 2 million. And then we have income tax payable, income tax payable. The answer they have given us as 3,500,000. And then we have accrued wages. All accrued are treated as current liabilities. We have what we call accrued wages, which was the answer was 300,000. And then we get our working capital. Or we can call net current asset. We can call it net current asset. Another name for working capital can be net current asset. So the answer, the total here, we shall get the total of 5. When you add all the current assets, we shall get 5,800,000. 5,800,000. So when you subtract, we shall say 7,810,000 minus the 5,800,000. So when you subtract, we shall get 2,010,000. 2,010,000. So when we get this 2,010,000, it's our net current asset. So we shall add it to our fixed assets. So we get 2,010,000 plus our fixed asset, which was, we are taking this figure of 10,100,000 as our total fixed asset. So when you add, what do we get? When we add, we get 12,110,000. So this is our total assets. So we have to get now to get our shareholders. We have to get our owners' equity. They have not, in our illustration, they have not given us owners' equity. So we are going to say financed by capital. So they have given us capital. They have given us capital as 7,810,000. 7,810,000. So that is the capital. So we add our net profit. From our net profit, shall add our net profit, the one that we got from our income statement. That's why I said it is very crucial for you to first watch income statement before coming to watch balance sheet. So we get our total, our net profit, which was 5,170,000. So after adding the profit capital, after adding the profit, we shall get 12,170,000. So we have to less now. We say less drawings. Have to less our drawings. So when you less drawings, we shall our drawings was 2,060,000. So that is our drawing. So when you say 12,170,000 minus this, we shall get 10 million. We shall get 10 million. 10,000. So this become our owners equity. Owner's equity. What the owner gets, the profit that the owner gets, it's the owner's equity. Because we have gotten the capital, we add the net profit that we have of the business, and then we subtract the drawings. So the amount that remains 10,110,000. That is our owner's equity. So what we do, we add long-term liability. Long-term liability. Long-term liability, which we have long-term. They have given us long-term loan. They have given us long-term loan of 2,000, of 2 million. Long-term loan of 2 million. So when you add all together, we shall get 12,110,000 as our capital employed. As our capital employed. So this amount, this is now, it's after adding the total liabilities plus the shareholders equity. This is the amount that we get. We call it capital employed. So you cross-check whether it is the same. So your total assets should be equal to your total liabilities. So ours is the same. We see that we have 12,110,000 as our total assets, and then also the capital employed is also the same. Thank you.